Stop what you're doing. If you own Verizon, or honestly any telecom stock right now, you absolutely need to see this. Last week, I sat down and ran Verizon's Q1 2026 earnings through 5 distinct valuation models plus Warren Buffett's and Peter Lynch's legendary checklists, and what I found completely shocked me. For the last 5 years, Verizon has basically been viewed as a dying dinosaur, right? Just slowly bleeding out to nimble competitors. But what if the ultimate value trap just flipped the script to become an unstoppable cash-generating machine? Welcome to this explainer. By the end of this deep dive, you'll know exactly if Verizon is a genuine wide moat Buffett buy or if it's just another classic Peter Lynch value trap. Plus, I'm going to give you a clear, actionable framework you can steal to evaluate telecom turnaround plays in your own portfolio.
We have to start with a number that totally shatters the current telecom narrative: 55,000. That is Verizon's positive first-quarter postpaid phone net adds for 2026. Now look, I get it. We all know the fear here. Retail investors are absolutely terrified of Q1 telecom earnings. It's a huge pain point because, historically, this is the quarter where companies just suffer massive, painful post-holiday churn. People cancel lines, they switch carriers. It's usually a total bloodbath. But get this, Verizon hasn't actually pulled off a positive Q1 in this core metric since way back in 2013. We are talking about over a decade of historical precedent being wiped out in a single quarter. So this isn't just them slightly beating expectations or having a lucky month. This is a massive, shocking disruption of a decade-old trend line, and it proves the underlying fundamentals of the business are rapidly shifting.
And you know, a fundamental reversal like that, it literally never happens by accident. This goes straight to the top. CEO Dan Schulman recently laid down a super aggressive mandate for the company. He flat out said, "Verizon will no longer be a hunting ground for our competitors." I love that phrasing. He pushed this ruthless, 100-day mindset shift as they closed out 2025. The entire goal here was to transform this massive, slow-moving company into a lean, outcomes-oriented machine that finally stops bleeding users and actually goes on the offensive to steal market share back.
And honestly, you can literally see this strategy hitting the pavement right here. Just look at the trajectory. A year ago, in the first quarter of 2025, Verizon took a brutal hit, losing 289,000 postpaid net adds. That right there, that was the hunting ground in full effect. But notice how things start to stabilize, and then we get this massive explosion in Q4 with 616,000 net adds. That was their best quarter since 2019. Now, the real test of any turnaround is whether a company can actually carry that momentum forward. Holding the line in the green during a notoriously brutal first quarter proves that the bleeding hasn't just slowed down, it's stopped completely.
But here's the thing, right? You can't fill a leaky bucket. A real turnaround isn't just about aggressively hunting down new users. It's about locking in the ones you already have. And Verizon crushed this. They drove 3.8 million wireless postpaid upgrades. That's almost a 6% jump year over year. But what's even more impressive is that their consumer postpaid churn dropped to a microscopic 0.90%. Less than 1% of their core base is leaving. Add in the 372,000 recent broadband additions, and the picture becomes crystal clear. They aren't just selling phones anymore. They're completely surrounding the consumer ecosystem.
Of course, having a healthy subscriber volume means absolutely nothing if it doesn't translate to the bottom line. And this is where the sheer operating leverage of a massive telecom network really flexes its muscles. They just hit their highest ever reported adjusted EBITDA for a first quarter. We're talking a staggering $13.4 billion. That is a 6.7% year-over-year jump. And get this, they achieved that even while dealing with one-time financial pressures from a major network outage earlier in the year. It's honestly a masterclass in scaling profitability.
Now, let's break down the core engine driving those profit numbers, because the underlying financial health here is phenomenal. Cash flow from operations climbed to $8 billion. Meanwhile, their capital expenditures, which is basically the cost of maintaining that massive, sprawling network, stayed incredibly disciplined at just $4.2 billion. So, because the cash they generated outpaced the cash they spent, their free cash flow expanded to $3.8 billion. Yes, there is a slight bump in their debt leverage ratio, moving to 2.6 times adjusted EBITDA, but their core cash engine is more than robust enough to absorb that hit without breaking a sweat.
So why does all that expanding free cash flow actually matter to you? Well, because it totally dictates your payoff as an investor. In Q1 alone, Verizon deployed a massive $5.4 billion in total shareholder returns. They protected and paid out $2.9 billion in cold hard cash dividends, and then threw another $2.5 billion straight at share repurchases. This is a textbook example of management putting their money exactly where their mouth is. They're shrinking the float and directly rewarding the investors who believed in this turnaround.
And look, they aren't just handing out cash. They are aggressively buying their way into decades of future growth. Finalized back in January 2026, the Frontier acquisition is basically the trump card in their whole national convergence strategy. Verizon didn't just buy a company here. They bought a massive infrastructure upgrade. They expanded their fiber footprint to over 30 million homes and businesses overnight. The play here is super clear. They are positioning to own both your mobile phone and your home internet, locking customers into these highly sticky, high-margin bundles.
This operational success, combined with that newly expanded fiber footprint, gave leadership the confidence to do something you rarely see in a volatile market. They officially upgraded their full-year guidance. They bumped their 2026 adjusted earnings per share growth estimate up to a 5 to 6% range. By doing this, they are practically screaming to Wall Street that this phenomenal first quarter was absolutely not a fluke. This aggressive growth trajectory is their new permanent baseline.
When you look at the rest of this upgraded outlook, it really paints a picture of a total step function change. They now expect postpaid phone net adds to land in the top half of their 750,000 to 1 million range. They're projecting free cash flow to clear $21.5 billion, which represents a solid 7% growth. And the best part? They are doing all of this while keeping their capital expenditures strictly capped. The math here is just beautiful. You take capped costs, add in growing sticky subscriber revenue, and it equals a massive cash-generating machine.
Which brings us to the ultimate question we have to ask. Will this ruthless 100-day mindset shift, paired with a massive fiber expansion, actually be enough to permanently dethrone rival telecoms over the next decade? Look, telecom is a brutal, capital-intensive war of attrition. But Verizon has clearly drawn a line in the sand, and right now, the numbers prove that they are winning. The real question is, can they maintain this aggressive momentum through the rest of the year? Thank you so much for joining me for this explainer. Keep a close eye on these numbers, because this turnaround story is far from over.